Not too long ago, when people wanted to buy a home, they went to their neighborhood bank for a loan. And they made their payments every month to the same bank and talked to the banker if there were problems. Life was simple. But over the years, the process of getting a mortgage became much more complicated. Instead of going to the neighborhood bank, homeowners found loans through independent mortgage brokers, who promised to find the best deals. Once the borrower signed on the dotted line, brokers got their commissions and were out of the picture. The bank making the loan usually didn't stick around either. Often within minutes of writing the loan, the bank would sell it for a quick profit to an investment bank. With so much paperwork changing hands so fast, the big financial institutions needed to keep track of who owned what. Their solution? The Mortgage Electronic Registration System, or MERS. The loan, the right to collect money, could be bought and sold several times. But the mortgage, the right to take the house if the loan isn't paid, was put in the name of MERS. More than half of all loans ended up in mortgage-backed securities, which were sold to pension funds, insurance companies, and other investors around the world. Investors hired a servicer who got a fee for collecting payments from homeowners. From here on, the servicer became the contact for the borrower. As long as the homeowner was paying, everybody was happy. Then the financial crisis hit. Real estate prices dropped, unemployment increased, adjustable rate mortgages rose. As homeowners found themselves with higher bills and lower income, more and more slipped behind on their mortgage payments. When homeowners turned to servicers for help, it was often too little, too late. The easiest route for the servicer was to file for foreclosure. This led to a feeding frenzy of late fees, legal costs, insurance charges, bills from process servicers, and maintenance crews. Everybody was billing a homeowner who couldn't pay. Foreclosure cases piled up in the courts. MERS, the database intended to make the system more efficient, created a legal snag when homeowners' lawyers asked, "Who has the right to foreclose?" Courts sent these convoluted cases to mediation. Sometimes loans were renegotiated so the homeowner could stay in the home. But more often, the debt had grown too big. Homeowners couldn't catch up, and the house went back to the bank, which put it back on the market. When a foreclosed home sold, usually at a fraction of the amount owed, the proceeds were divvied up with investors at the end of the line. So who loses? If the loan was government guaranteed, taxpayers make investors whole. If the loan wasn't backed by the government, the investors take the hit. But those investment losses ultimately filter down to the public. When a homeowner can't pay his mortgage, everybody pays.